Capital flows can bring substantial benefits for countries, but also carry risks. Implementation of capital flow management measures typically requires that financial intermediaries verify the nature of transactions and the identities of transacting parties, but it is facing rising challenges of crypto assets. With that, we'll be discussing of one of the IMF fintech notes, capital flow management measures in the digital age, challenges of crypto assets. Capital flow management measures, or commonly known as CFMs, can be part of the broader policy toolkit to help countries reap the benefits of capital flows while managing the associated risks. Their implementation typically requires that financial intermediaries verify the nature of transactions. Indeed, crypto assets have become a significant instrument for payments and speculative investments in some countries. They can be traded pseudonymously and held without identification of the residency of the asset holder. Many crypto service providers operate across borders, making supervision and enforcement by national authorities more difficult. Challenges posed by the attributes of crypto assets are compounded by gaps in the legal and regulatory frameworks. This demonstrates market capitalization of crypto assets relative to gold, S&P 500, and US Treasury debt markets. Accordingly, crypto assets have grown considerably in market value. They are now a significant instrument for payments and speculative investments in some countries. Globally, the scale of crypto assets remains relatively small at 2 to 3 trillion dollars, or about 1% of total market value of financial assets. This denotes market capitalization of total crypto assets. In some countries, large segments of the population now have exposures to crypto assets, and trading of USD linked stablecoins with regard to some emerging market and developing economic currencies has soared since 2020. This denotes total value locked in decentralized finance and stablecoin market capitalization. Alongside the rapid growth in scale, market structure has been changing. Stablecoins have gained market share, and the decentralized finance, or commonly known as DeFi, market has grown into a multi-billion-dollar industry. This exhibits crypto adoption of top 20 countries. Vietnam, India, and Pakistan lead the index, and also Tanzania, Afghanistan included in this index as well. Geographically, top 20 countries with the highest intensity of crypto adoption are composed of emerging market and developing economies from Asia, Latin America, and Sub-Saharan Africa. Crypto exchanges play a vital role in this ecosystem. Most large crypto exchanges are centralized entities. Gaps in regulatory frameworks for crypto asset service providers and differences in national approaches could lead to regulatory arbitrage. Importantly, many crypto service providers operate across borders and are often headquartered in jurisdictions with favorable regulatory, tax, and legal frameworks. As displayed according to the Financial Account Restrictiveness Index, formerly known as FARI, more than 90% of IMF member countries had some types of restrictions on capital flows in place at the end of 2019. Out of those member countries, almost half had only very limited restrictions, while 21 countries had extensive restrictions in place. Restriction intensity is higher in developing countries, followed by emerging market economies. Advanced economies have largely liberalized their capital accounts. This reveals decentralization and ability to regulate. In the figure 3, as shown, the more important decentralized the ecosystem is, more difficult it is to regulate. A multifaceted concept, decentralization relates to not only the governance structure for creation and destruction of crypto assets, but also the role of service providers such as exchanges and custodians. New crypto asset services and products are being continually developed to offer highest degrees of anonymity and more privacy to users. When crypto asset services are web based, common privacy techniques are used to conceal personal data, such as the IP addresses. When interacting with the blockchain directly by launching a node or using unhosted wallets, advanced users can have better control of their data. This demonstrates how mixers create untraceable transactions. The common strategy consists of unlinking a new address from the past transaction history by using mixers and complex layering. Crypto assets can be used as a vehicle as shown in this figure 5 to circumvent controls on capital outflows. This shows a user who exchanges local fiat money into crypto asset such as Bitcoin or a stable coin denominated in a foreign reserve currency via digital wallets and services provided by crypto exchanges or platforms on an off-ramp through apps on mobile devices or other means such as automated teller machines. To preserve the effectiveness of CFMs in an environment of growing crypto asset use, policymakers need a multifaceted strategy. Essential elements of such a strategy include developing a comprehensive, consistent, and coordinated regulatory framework to crypto assets and applying it effectively to CFMs, establishing international collaborative arrangements for implementation, addressing data gaps, and leveraging technology, RegTech or SubTech, to allow for timely risk monitoring and striking a good balance between ex ante and ex post enforcements. Recent regulatory actions issued by Canada, Italy, Japan, Lithuania, Singapore, Thailand, and UK against Binance suggest that it may be feasible to have some regulatory control over unauthorized service providers located overseas. Enforcement, however, may be challenging for regulators with capacity or technological constraints. In some countries, for example, China and Kenya, crypto asset service providers are perceived as risky business and denied access to bank accounts and other regular financial services. UK Financial Conduct Authority or FCA issued a public warning in June 2021 that Binance Markets Limited is not currently permitted to undertake any regulated activities without the prior written consent of the FCA. No other entity in the Binance Group holds any form of UK authorization, registration, or license to conduct regulated activity in the UK. People's Bank of China, for instance, has leveraged artificial intelligence, big data, and other technologies to develop a supervision information system for payment transactions. Use of RegTech has also advanced in financial centers in Europe, including France, Germany, and Luxembourg, and in other jurisdictions such as Australia, Canada, Hong Kong, Japan, and Singapore. An example of regulatory cooperation relating to overseas online financial service provider is as follows. State Administration of Foreign Exchange of China informed the Australian Securities and Investment Commission, known as ASIC, that some online platforms are illegally engaged in forex margin trading activities. However, even with such a multifaceted strategy in place, the challenges crypto assets pose to CFMs will likely persist, especially in emerging market and developing economies. Nevertheless, a comprehensive legal and regulatory framework, as well as its consistent implementation, will likely be conducive to the emergence of law abiding and regulatory compliant innovations, while providing the basis and mechanisms to deal with the minority of bad faith actors and criminals. Reference for today's presentation is from IMF FinTech Note dated 10th May 2022. Thanks for watching.